At your choice. Any points on this that you would like to comment on? If I could, let me introduce Peter. Peter is former head of the World Bank in China and professor at the School of Advanced International Studies at Johns Hopkins, and one of the best economists I certainly know on this subject. So, Peter, give me your take.
Well, I'm very impressed, Malcolm, by Bob's presentation. The many questions. Let me just focus on one. I think Bob mentioned, and I believe correctly, that the Chinese would hate to see their share in the SDR decline from 10.8 or 10.9 at the present time. Yet, there are pressures going on, as Bob also mentioned, that would precisely do that. Now, my question is, in what way will the SDR inclusion therefore affect domestic economic financial exchange rate policies in China?
That is a very essential question, and I thank you, again for your flattering comments. I'm honored to have your praise. So the SDR onshore is going to have two effects. One, it makes the ability for the authorities to live with this kind of dollar volatility ongoing. It also means, so I don't expect this chart to go back to the quiet period of 2008 to 2011. It's just not, a dollar peg is gone. A dirty peg or its quiet appreciation is gone. What we're going to continue to see in China is an increasingly volatile reflection of both capital inflow and outflow, trade flows in and flow and outflow, and an increasing reflection of the internal inflation or deflation pressures on the currency. So I think what we're beginning to see, if they want to maintain 11% or so market share in the SDR, they're going to have to deal with increased volatility. They're going to have to see an incredibly focused path to including more assets available to foreigners to invest in China. So some of that is going to be the A shares being owned by foreigners, and increasing pressure on them to increase the RQF or come up with an entirely new regime to increase the size of Chinese assets that can be held abroad. And that makes, it basically, it puts the authorities in a increasingly difficult triangulation. The holy trinity of fixed currencies is lost. And the SDR is going to mean that they are going to be seeing increased foreign exchange volatility, not just against the dollar, but across all of their relationships. That's a long-winded answer, but one that may mean that they will find that their reserves that they have are less important than their political relationships in allowing asset negotiations and investments. This gets very complicated very fast for them.
Peter, what else?
Well, I'd like to leave the floor. I'm keen to hear other questions. This is such a complicated subject.
Yes, it is. Let me go with the questions. I've done my best to unmute you all. Is there anybody, Regis, trying to speak again? Somehow we're having a problem with the platform. I'll have to get with the service. Okay. Let me ask the questions that have been sent to me, and please write yours into the Q&A, and I will get to them. We have quite a number. For this, I have a question. Given the recent reports on the leadership succession, or lack thereof, for President Xi, is there a direction on this that favors his continuance or his keeping the two-term pattern? You have any thoughts on that, Bob?
Look, the speculation about Chinese politics is it makes the U.S. election look, like a child's play. They don't have polls that really capture the Politburo's, internecine battles. But it seems to me that she is absolutely more powerful than almost any premier since Mao. And part of that was by design. The Communist Party wanted reform, and they got it. I think the idea that you're going to not see a two-term or a continuation of policy isn't my base case. I actually think that what she is looking for is someone to trust in fixing the economy. If there's one weakness in Xi, it's that he doesn't believe in markets, and he doesn't really understand any of the economic advisors that he's had in their lack of success, and therefore his level of trust for them. So I look at 2017 as a very big leadership change for the economic portfolio, if you will, in his cabinet, to make it all look and sound Western. And I think there will be some bumps and bruises out of that. Having said that, I'm an eternal optimist. I think that the Chinese run their country very well, and I would be foolhardy to think that Westerners like myself will ever know the internecine battles that are behind the scenes. I do think that we will have some island of stability about this far before October.
Peter, I'm going to not continue on this course. We only have a little bit of time. I'd love to get your views on this when we talk. The second question here is, what is the, and this is another, these are both political, that's why I kind of like them. What is the implied view of the Trump candidacy in this analysis? Said another way, how much of a shock and in which direction would a Trump victory be to these exchange rates?
That's not my base case, and I'm not a politician. The market odds of Trump winning are still uncomfortably small, but I don't think that we should be thinking that that's the base case. But on the tail risk of that happening, if Trump actually does rejigger trade relationships or put up a embargo against U.S. Imports from China, there's going to be a couple of things that happen almost immediately. A significant rise in prices across the board in a lot of consumer goods in the U.S. leads immediately to inflation and very angry voters. I think that the backlash against that, where most U.S. international companies have very strong trade relationships with China, Apple being, an obvious one, where the iPhone cost would suddenly zoom to probably 2,000 instead of the rather quiet 800, and the idea that you're going to have a 100% increase in electronic goods or some industrial goods is pretty terrifying. I think the other point would be, again, geopolitical, which is the relationship of the U.S. to Asia. The Obama pivot to Asia out of the Middle East was going to be, the crowning jewel of his administration. And I think it's going to be one of the things that really is under focus in whoever wins the next election. I think Clinton or Trump are going to face a very difficult time in convincing Asian partners like Japan, Korea, Thailand, the Philippines, to increasingly toe the line on Chinese relationships and pressure for Chinese reform. That just ain't going to happen. And if Trump is too extreme in his approach, I think the backlash against the United States globally will be painful and lead to a smaller U.S. Global trade relationship.
We're running out of time. Let me move on to the next one here. Does the lower Fed terminal rate take a big risk off the table from an FX management standpoint? It seems like it should.
Well, lower for longer has other problems. Lower for longer increases the risk of the tail inflation risk. It increases the pressure on savers. And let's be clear, China is a saver more than it is a borrower. So they have a non-performing loan problem because they also have a savings glut that can't be expressed in normal channels. So they have a property bubble, and you had a stock market bubble, and you've had increasing commodity bubbles that have come out of their capital controlled environment. It seems to me that the lower for longer problem in the US means that there's less likelihood that some of the Chinese capital that was easy to keep here in the halcyon days pre-2008 when bond yields were 4 or 5%, that has gone, and it makes the world far more complicated for savers to find a safe home. It does relieve pressure on the renminbi and the appreciation game, but it does make the Chinese yuan, Chinese yen relationships that much more complicated. So it isn't a panacea. And it also opens up, as I said before, the world to a future inflation spike that will test the ability of central banks to remain credible and actually stay ahead of the inflation curve 5-10 years from now.
Peter, can I put that same question to you? Peter?
I'm sorry, I was distracted.
That's okay. Let me give it to you again. Does the lower Fed terminal rate take a big risk off the table from an FX management standpoint?
Well, that's impossible to answer in a few minutes, or even in 10 or 20 minutes. The monetary policy situation globally is so complicated at the moment, and I'm the last one who really knows how to answer that question. I think the recent decision by the Fed to stabilize the situation at least until December will probably suit the Chinese, but the inevitability of increases at some point is the overriding issue. And how that plays out in the Chinese foreign policy and Chinese foreign exchange management and exchange rate management, I honestly don't know.
Well, I should say that one of the reasons why Peter is the most favorite of all our speakers is his willingness to say, I don't know, when he doesn't know. And in a world of pundits and of people who are convinced of the rightness of their point of view, it's wonderful to hear that. Okay, next question. Please explain more how China can maintain a firewall between the CNH and the CNY.
I think it can't if it wants to maintain its SDR share. Over time, it's just going to get more and more porous. And I think that they're actively trying to make clear that they can intervene in both. So I think it's going to be increasingly porous, but increasingly clear to players that are trying to destabilize in their minds or play for arbitrage that that's not necessarily a free lunch. And that's the best I got.
Okay, that sounds good. Peter, any thoughts?
I think the CNY exchange rate differential is the Achilles heel of the whole system. As Bob was pointing out, this is not consistent with China's objective of an open capital account. And ultimately, it cannot last. Something will have to give. I think the financial authorities will try to open the capital account as far as they can, as far as the political authorities will allow them to, in order partly to depress the differential between the CNH and the CNY. But again, this is such a hugely complicated subject. You cannot possibly exhaust it in a few minutes. But as I said, the exchange rate differential between the two is due to the partial closure of China's capital account. If you were to open the capital account totally tomorrow, that differential would disappear. And the whole rationale for the CNH would in fact disappear.
Well, we are just about at the end of our hour. Bob, would you please give some closing thoughts? And I apologize for not getting to everyone's questions. If you still have pressing questions, please email them to me and we'll do our best to answer them. Bob?
Sure.
Bob.
Thank you. I think currency trading is increasingly very short term. And the relationship of holding a position in a currency, whether it's CNH or euro or yen, has become seconds or minutes rather than days and months and years. So it's a pleasure to talk longer term about the future of the renminbi. And when you think about the renminbi, you have to think in the Chinese construct of short term to them is actually a year or two. Medium term is a decade. Long term is 100 years or more. So I think to understand the problem of trading this currency pair is that the authorities are getting hit wave upon wave with outside crisis capital flows and flight that really hit at the confidence of the people themselves and the assets that they hold. And the ability for the Chinese to, just like any other major country, financial conditions and financial stability is going to be increasingly difficult to hold together, particularly if we see bigger and bigger political shifts, whether that's in Europe or in the United States or in China itself. Particularly if we see continued monetary policy divergence from the Fed to the BOJ to the ECB. And I think that the only certainty that I have about the renminbi is that it's going to be increasingly volatile, and that the authorities will try their best to make it a haven, just like the British pound or the yen or the euro against the dollar at certain periods of time.
Thank you. Peter, how about you? Anything you'd like to?
Well, I totally agree with that. I'm also very full of trepidation about forecasts, but I think Bob's characterization of the key issue, the probability of increased volatility, I totally agree with. I think ultimately the very existence of the CNH is inconsistent with China's objective of being a reserve currency. So if they want to be a haven currency, dollar-style haven currency, they will totally have to open the capital account, which politically is not possible in China at this point.